Renewed political conflict is understandably dominating markets. Good morning. It's understandable to feel uneasy at events in the global landscape over the last week. What we're going to try and do today is provide some context for the reactions in markets across not just equities and bonds, but also in currencies and asset classes such as gold. So since the original strikes on Iran by Israel on the 13th, global equities are down around 1.4 percentage points. Since the attacks by the US, equities are actually quite flat. They've barely fallen overnight, so the reactions have been modest. The good news is that global bonds are acting as a diversifier in this environment, but only modestly, and that's because the global equity fall itself has been modest. Over the last week or so, the yield on a US 10-year Treasury bond, that is, a bond issued by the US government, has fallen around about 4 basis points. So investors have seen a positive return on both the price of the bond and from the income stream in this short space of time. However, in other historical environments, you would expect to see a bigger rush or a flight to safety for more safe assets, such as the US dollar or gold. In fact, we've seen relatively benign response. Gold has actually fallen in price by about 1 percentage point, and the dollar itself is only up similar, around about 1 percentage point. So very benign market moves for what is an unexpected political environment. So let's focus on the week ahead. Well, the data this week is itself relatively quiet. We will get some activity surveys from Europe. We'll also get initial inflation prints for most of Spain, Italy, France, for inflation for the month of June. Those will be flash prints, but they're likely to confirm that we remain in a period of benign inflation or disinflation. We'll receive two interesting data points from the US. The first is the last revision for Q1 GDP. It's likely to confirm that the US remained in a very modest contraction for Q1, but it's largely irrelevant given that Q2 data points to a robust rebound. Finally, we'll get core inflation for the US for the month of May. This core inflation is the data that matters for the US Federal Reserve. It's likely to confirm that US core inflation remains around 2.5%, which is in line with expectations and will not in any way force the hand of the Fed to bring forward their expectations for future rate cuts. So given all that, the expectations and market focus this week is going to be focused in on events between the US, Iran and that of Israel as well. What we do know from some reactions last week is that any indication of compromise or diplomacy will likely see a positive reaction in equities. That's what we were seeing on Thursday through Friday, where US equities were rising close to all-time highs. So we know that the underlying trend for markets remains buoyed by global trends which have been in place for the last 2 years, which is strong nominal GDP and fiscal deficits from governments supporting consumption and spending. So the underlying backdrop remains incredibly supportive, if not for the political noise that we must look through. That's all for today, but please join us through the middle of the week. We'll bring you up to date with the recent economic data. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.